All right, if you're a small business owner, maybe doing some gig work, or really anyone who drives a lot for work, you're going to want to listen up. We're diving into vehicle deductions, which can save you a ton of money. But there's this one hidden trap, a really sharp turn that you've got to know about. Okay, let's get into it. So let me just ask you straight up. Are you using your personal car for your business? Maybe you're doing deliveries, running a service business, or just driving out to see clients. For most of us, the answer is a big yes. And, that means you've got a huge opportunity to lower what you owe in taxes. And for 2025, this is the number you need to burn into your brain, 70 cents. That's the standard mileage rate. So think about this. Every single mile you drive for your business could be a 70-cent deduction. It adds up so fast. Let's say you drive 10,000 business miles. That's a $7,000 deduction. It's honestly one of the best tools a small business owner has. Now, when it comes to actually taking these deductions, you basically have two main roads you can go down. And the choice you make right at the beginning, well, it has some pretty major consequences later on. Okay, so option one is that standard mileage rate we just talked about. It's super simple. You just track your miles, multiply by the rate, and you're done. Option two is what's called the actual cost method. And with this one, you track everything. We're talking gas, oil changes, new tires, insurance, and even depreciation on the car itself. It can add up to a bigger deduction for sure, but man, it is a lot more paperwork. So that choice between simple and complicated gets way more important as your business starts to grow. Because at some point, you're going to hear people whispering about switching your business over to an S corporation. It's a really, really common move, and honestly, it's for a very good reason. And that big reason? It's all about saving money on one specific and pretty painful tax, the self-employment tax, right? This is what covers your Social Security and Medicare. And when you're the boss, you get to pay both the employee and the employer side of it. Fun stuff. Which brings us to this monster number, 15.3%. If you're a sole proprietor or a regular LLC, you are paying a flat 15.3% on pretty much everything you earn. But in S-Corp, it lets you pay yourself a reasonable salary and then take the rest of the profit as a distribution, which, and this is key, is not subject to that 15.3% tax. The savings can be absolutely huge. So the path forward seems pretty obvious, doesn't it? You grow the business, you switch to an S-Corp, and you just watch that tax bill get smaller. Sounds like a total no-brainer for any smart business owner.
But, and you knew there was a but coming, this is where that smooth highway you're cruising on suddenly hits a massive roadblock. Choosing to be an S-Corp isn't just filing some extra paperwork. It fundamentally changes the rules of the game, especially when it comes to your car.
And it's a really big one. A catch that so many business owners just do not see coming until it's way too late. Because the second you make that S-Corp election, the rules for deducting your vehicle expenses can change completely. Okay, this is the slide you really need to see. If you're an LLC and you want to use that actual cost method, your car just has to be used for business more than 50% of the time. Seems reasonable. But the moment you flip that switch to an S-Corp, that requirement jumps to 100%. Not 99%. 100% business use. No more driving it to the grocery store. Period. And if you're wondering why the rule is so strict, this quote really sums up the IRS's logic. They basically see it like this. A corporation is a business entity. It doesn't have a personal life. It doesn't need to pick up kids from school or go on vacation. You do, but the corporation doesn't. So if the corporation is taking the deduction for all the actual costs of a vehicle, that vehicle can only be used for corporate purposes. So does this mean you're totally out of luck if you become an S-Corp and you still want to, live your life? No, not at all. It just means you have to get a little bit smarter with your strategy. There is a way to handle this. And the key to this whole thing is something called an accountability plan. That sounds super formal, but really it's just an official system you set up that lets your S-Corp pay you back as an employee for the business miles you drive in your personal car. This is how you get around that crazy 100% rule. So here's exactly how it works. First, when you have an S-Corp, you're not the owner anymore, you're an employee. So you become an employee of your own company. Second, you track your business miles just like you always would, but now you submit a mileage report to your company. And third, the S-Corp reimburses you for those miles. And here's the best part. That reimbursement is a tax-deductible expense for the company, and for you, it's 100% tax-free income. It's a win-win. Okay, so let's pull all this together.
What is the one thing you absolutely have to walk away with today before you make any big moves with your business structure or how you deduct your car?
All right, let's lock this in. First, just remember that this simple mileage rate is usually your safest, most flexible bet, especially when you're using a personal vehicle. Second, and this is the big one, becoming an S-Corp means the actual cost method demands 100% business use. That's a really high bar. Third, this proves that how your business is structured and how you take deductions are totally connected. And finally, know that you can't just flip-flop between these methods every year. The choice you make at the beginning really matters.
So, what it all comes down to is this. If you're like most people and you're using one car for both your business and your personal life, that standard mileage rate is your flexible friend. It keeps things simple and helps you completely avoid this S-Corp trap. Unless you have a vehicle that is truly 100% dedicated to your business, like a work van that never goes home, the mileage rate is almost always the easier and safer way to go. And that just leaves us with one last question for you to think about. Don't just plan for this year's taxes. Think about where your business is headed in 2 years, 5 years. As you plan for that growth, is your deduction strategy going to grow with you, or is it going to create a trap for you down the road? Plan ahead. Because setting yourself up for success right from the very beginning, well, that's the smartest move you can possibly make.